In this video, we're going to compare futures against CFDs and how they're cost efficient for swing trading and long-term investing strategies. So today's topics are what are futures and what are CFDs, and then we're going to compare the relationship between those two financial products. And then the last thing is we're going to run an experiment where we're going to place some swing trades and long-term investment trades to see how they perform. So first, what are futures? Futures are a financial derivative, and they're basically just an agreement to transact an asset at a future date. And most commonly, people trade, for example, at the CME, where you can, for example, trade the E-mini S&P 500 futures, or if you trade commodities, you can also trade the gold futures or crude oil futures. Then you also have the possibility, for example, trade Bitcoin, which is MBT. And usually, retail traders do not have access to the CME directly. So if you want to trade at the CME exchange, you'd have to sign with a broker like Interactive Brokers or TradeStation, where they provide access to the futures products. And now the question is, what is a CFD? So a CFD stands for contract for difference, and it is also a financial derivative. But instead of owning the asset you want to trade, you're basically just speculating on the price difference. And if you guess it right, then you will make money. And so CFDs are commonly offered through a platform such as MetaTrader 5, through brokers, for example, such as Blueberry Markets or IC Markets. But there are many more on the market. So if you just search online, there are hundreds of brokers who offer CFDs. So here's a quick table where I'm displaying the differences between futures and CFDs. So futures, they have something called an expiry date. So if you buy a futures contract, you will have to close that position before the expiry date. And CFDs, they don't have that. So if you buy a CFD, you can buy and close it whenever you want. In futures, the broker is not your counterparty. So it means that broker is not trading against you. But in CFDs, it is very common that the broker or the market maker is your counterparty because there is no open exchange in this case. And so we're coming to point number 3. Futures basically represent a transparent exchange because you can see all the trades and the liquidity that is being traded on the futures contract. But on CFDs, all you see is just a bid and ask spread quoted by your broker. So you don't see, how many trades are being performed on this contract, or you don't see the liquidity. So that's also sometimes a problem if you want to see the exact trading dynamic. So as a result, on the futures market, the pricing reflects the real market because you see the real transactions going on, but the prices quoted by the market maker may not reflect the real market. So what the market maker may do is they can mark up the spreads, mark up the swaps. So there might be slight discrepancies between what you might see in the real market. Then let's talk about the overnight fees. So if you trade futures, futures have 0 to low overnight fees based on the margin utilization, whereas CFDs, they do charge overnight fees, or they also refer to them as swaps. And so what they do is they charge swaps on the entire position value regardless of margin utilization. So when it comes to overnight holding, futures are better if you trade them long term. I'm going to show you an example later in presentation with the exact numbers. And so the last point is that futures, they track the asset value in a future because the expiry date is set at the future date. But the CFD price, what it does, it tracks a value at the current present time. So here's a price chart between August and September. So the blue line represents the future price, right? So here the blue line is our S&P 500 E-mini contract. It is the September contract. And then the red line here is a CFD price from the broker IC Markets. So here I exported data from IC Markets. And what you see here is that these prices reflect the S&P 500 price. What you can see is that the futures price is slightly above the CFD price because what's going on here is that the futures price is taking the future price into account. And so when we talk about the futures price, it does not have to reflect exactly the CFD price. So when we take the difference between the future CFD, you see on the right side that there is something called the basis. And the basis is nothing else than the difference between the futures price and the spot price. So what does affect the basis price, right? The basis is affected by multiple factors. So something like market sentiment. Do traders believe that the future price of our asset is higher or lower, right? It's affected by the interest rates, dividends, if you trade stocks or indices, or if you trade commodities, it is affected by the storage and transportation cost. But there is one rule that futures price follow, and that is that as we are nearing our expiration date, the basis is approaching zero. So basically, if we go back to our price chart here, you see that over time, as we are nearing our expiration date, the difference between futures and spot is becoming zero. So this is a little bit off topic, but the question is, can you arbitrage futures and CFDs? Because, for example, you see that the CFD price here is lower than the futures price. So what you could do, for example, is you can buy CFD, sell futures, and then as over time the difference narrows, you should be able to make a profit. And that is true if you fund the position yourself. But the only problem is that the return that you make on this arbitrage is lower than the risk-free rate most of the time. So if you just put your money into bonds, which are basically risk-free, you would yield a higher return than if you tried to hedge these two positions. And because we are talking about CFDs here, right? So CFDs by nature represent trading on margin. The cost of borrowing money for trading a CFD contract is higher than the return if you hedge these two positions. So this is just a little off topic. So now let's go back into the main topic. Which asset is better for swing trading or long-term investing? So on the left side, we have our futures price chart, and we are basically buying one contract of the E-mini S&P 500 futures, the September 2025 contract, and that would represent 50 CFD contracts on IC Markets, which is our CFD provider. So we are entering and exiting both trades at the same time, and let's see how they perform. So price-wise, if you look at the P&L chart on the left side, so basically these are the two trades that we have shown here. So here we are displaying the P&L of both trades, and what you see here is that the CFD P&L is slightly above the futures P&L. And if we compare the P&L performance of the both charts, we see how the futures is slowly underperforming the CFD. But this is purely speaking about the price, and that's why I added a but, because the point of this video is to prove to you that futures are actually better than CFDs for swing trading. So what we have to talk about is that CFD brokers, they charge swaps. So a swap in CFD is an overnight charge for holding a position. And here you can see the swap long that is on the S&P 500 for at IC Markets. So every day you hold a long position on S&P 500, you're being charged minus 1.669 US dollars. So if you buy 50 contracts, so let's go back here. So one ES contract represents 50 contracts on the S&P 500 for a CFD contract. So that would actually mean that overall we'd be paying 50 times this amount. But let's say the swap long right now is minus 1.669. So if you multiply that by 365, you will be paying minus 609.18 US dollars per year for holding this long position the entire year. The only problem is that S&P 500, the current market price is 6,730 US dollars. So if we divide 609 divided by 6,730, you'd be paying a 9% interest for holding a long position. And people say, right, overall the stock market returns 10% per year on average, roughly like that. So if you pay 9% in interest per year, you are giving away all your profits in swaps. And that is the sad truth of CFD trading, that the swaps are too high to actually swing trade or hold an investment long term. So if we apply the mathematics with the swaps, so now we are actually deducting profits from the CFD curve by actually subtracting the swaps. We see that the futures P&L is now outperforming the CFD P&L. And on the right side here, you see how much the swaps are actually eating away the profits from our CFD position. And so over the course of this month that we're trading S&P 500, we're losing over $2,000. And here I have a very simple calculation. So if you're interested in that, you can pause the video and then analyze exactly what's going on. But with a trade that I've shown you that lasted 27 days, on the futures contract, we made a P&L of plus 8,637 USD. The spread on this is about 25 cents, so let's just neglect that. And the commission is just minus 1.7 USD. We're assuming that the overnight cost is zero because we're financing the entire position with our own capital. But in some cases, if the margin requirements are higher, you might also be charged overnight commissions on the futures contract, but they're almost negligible in this calculation. So overall, the net profit on the futures contract was plus $8,635. On the right side, you can see the calculation on the CFD contract. So P&L wise, we made a profit of plus 9,350 USD. So that's higher than on the futures contract. But now if we apply the overnight cost or a swap charge on the CFD contract, you will see that we're being charged minus 1.669 USD per contract. And because we have 50 contracts, we're being charged minus 83.45 USD per day. So our trade lasted 27 days. So if we multiply all of that, we were charged minus $2,253 for holding a position for 27 days. So our net profit reduced. So our profit reduced from plus 9,350 to plus 7,096. So suddenly our CFD position underperformed compared to the futures product, and that is a difference of minus $1,538. So here we have the swaps visualized. So I just want to visualize how much swaps are eating away your profits every day. So here we see how the futures product, the futures is outperforming the CFD. And on the right side again, we see how much the swaps are eating away our profits. So my main point is that trading futures is more cost efficient for swing traders and long-term investors compared to CFD. That was the main point of this presentation. And so as traders, we must maximize the edge. And that means if you're trading CFDs and you hold your trades for weeks and months, you will minimize your losses because you know that over time, the swaps are eating too much away from profit. So if you switch to futures, you will definitely save money on your trades. So now I hated a bit on CFDs, and the question is, are they good for anything? And the answer is yes. In some cases, they're good. For example, for intraday trading, the bid-ask spread on some assets can be very tight, and that is very good for intraday trading. And CFDs, they also offer high leverage. So if you want to maximize your gains, that is also a double-edged sword. So you can actually open much bigger position. But I do not recommend that because in most cases, high leverage is not necessary for your trading. So thank you for joining today's presentation. If you have any questions, feel free to add them in the comments below and I'll do my best to answer them. So thank you very much for watching and I'll see you in the next video.